After a powerful 5-day rally, the Indian stock market finally hit the brakes today. Nifty closed below the psychological 24,100 mark. Sensex lost more than 600 points and IT stocks witnessed heavy selling pressure. But here's the real question. Is this just profit booking after a strong rally, or is a deeper correction beginning? Stay till the end because I'll explain why the market fell today, which sectors outperformed, top gainers and losers, what FIIs and DIIs are likely doing, and the exact levels traders should watch on Monday. Market closing summary. Today, Indian equity markets ended lower and snapped their 5-session winning streak. Nifty 50 closed 24,013.10 down, 154.90 points, minus 0.64%. Sensex closed around 76,800, down approximately 600 points. Despite today's fall, markets have still delivered positive weekly returns due to gains earlier in the week. Reuters. Why did the market fall today? There were 5 major reasons behind today's decline. Reason 1. Massive selling in IT stocks. The biggest drag on the market came from information technology stocks. Global IT giant Accenture issued cautious guidance, raising concerns that discretionary technology spending may remain weak. As a result, Infosys, TCS, HCL, Tech, Wipro, Tech, Mahindra faced significant selling pressure. The Nifty IT index plunged sharply and hit multi-year lows. Analysts fear that earnings recovery in the IT sector could be delayed. Reuters. Reason 2. Profit booking after 5-day rally. Markets had rallied strongly over the last 5 trading sessions. Whenever markets move sharply higher, traders often book profits at higher levels. Today's correction appears to be a healthy profit-booking move rather than panic selling. Many traders use the rise toward 24,200 levels to lock in gains. Reuters. Reason 3. Weak global sentiment. Global markets remained cautious. Investors were monitoring global growth concerns, technology spending outlook, geopolitical developments. This cautious environment led to risk-off sentiment across emerging markets, including India. The Times of India. Reason 4. Banking heavyweights under pressure. Apart from IT stocks, banking giants also contributed to the fall. HDFC Bank declined after developments regarding the extension of the interim chairman's tenure. Because HDFC Bank has a large weight in Nifty and Sensex, even a moderate fall can significantly impact the indices. Reuters. Reason 5. Market breadth turned weak. Large-cap stocks witnessed broader selling pressure. Investors shifted towards stock-specific opportunities rather than index-heavy buying. This weakened overall market sentiment. Heat map analysis. Looking at today's NSE heat map. Red zone. 1 stocks. Infosys, TCS, HCL, Tech, Tech Mahindra, Wipro, Financials, HDF, C-Bank, Kotak Bank, Oil and Gas. Reliance witnessed profit booking. These heavyweight stocks dragged Nifty lower. Green zone. Defensive and select consumption names remained resilient. Strength was visible in Trent, Apollo Hospitals, NTPC, Power Grid, Bharat Electronics. These stocks helped limit the market decline. Top Nifty gainers today. According to NSE data, the major gainers included Eternal, Bharti Airtel, Power Grid, Nestle India, NTPC. These stocks showed relative strength despite overall market weakness. Top Nifty losers today. The biggest losers were largely from the IT sector: Infosys, TCS, Tech Mahindra, HCL, Tech M&M. Technology stocks dominated the loser list. Sectoral analysis. IT sector. Biggest loser of the day. Negative global cues and Accenture's commentary triggered heavy selling. Banking. Private banks traded weak. HDFC Bank contributed significantly to index pressure. FMCG. Relatively stable. Investors rotated into defensive sectors. Pharma. Selective buying continued. Defensive positioning helped support the sector. Power and PSU stocks. Power stocks remained relatively resilient. NTPC and Power Grid showed strength. What FIIs and DIIs may be thinking. Foreign investors generally react quickly to global developments. With concerns around global technology spending, FIIs may have reduced exposure to IT stocks. Domestic institutional investors are likely providing support through selective buying in defensives and quality large caps. Technical view on Nifty. Immediate support 23,900, 23,800. These levels are crucial for bulls. Immediate resistance 24,100, 24,200. A sustained move above 24,200 could revive bullish momentum. Market experts expect Nifty to remain within a broad 23,800, 24,200 range in the near term. Reuters. What to watch next week? Investors should closely monitor global technology sector developments, US market movement, FI activity, crude oil prices, rupee movement, corporate earnings expectations. These factors could determine whether today's decline remains a one-day correction or develops into a larger pullback. Today's market fall was primarily driven by IT sector crash, profit booking, weak global cues, pressure on HDFC Bank, cautious investor sentiment. At this stage, the broader market structure remains intact, but traders should watch the 23,800 support level very closely. A break below that zone could invite further selling pressure. However, if Nifty reclaims 24,200, bulls may regain control. Do you think today's fall is just profit booking, or is a bigger correction coming? Comment below with your Nifty target for next week. And if you want daily stock market analysis, IPO updates, SEBI regulations, and corporate law insights, subscribe to channel and press the bell icon for regular updates. Disclaimer. This video is intended solely for educational, informational, and awareness purposes. The views, opinions, market analysis, stock discussions, financial data and observations expressed in this video are based on publicly available information, personal research, and interpretation as of the date of recording. This content does not constitute investment advice, stock recommendations, financial advice, tax advice, legal advice, or solicitation to buy, sell, or hold any securities, financial instruments, mutual funds, derivatives, or other investment products. Investing and trading in the securities market are subject to market risks, including the possible loss of principal. Past performance is not indicative of future results. Viewers are strongly advised to conduct their own independent research and consult qualified financial advisors, investment professionals, tax consultants, or legal experts before making any investment or trading decisions. The channel owner, presenter, and associated persons shall not be responsible or liable for any financial loss, investment loss, trading loss, damages, or consequences arising directly or indirectly from the use of information contained in this video. Any references to listed companies, IPOs, stock exchanges, market indices, regulators, products, services, or market participants are purely for educational and analytical purposes and should not be construed as endorsements or recommendations. The information presented may contain inadvertent errors, omissions, or inaccuracies despite reasonable efforts to ensure accuracy. Viewers are encouraged to verify information independently from official sources. The presenter is a member of the Institute of Company Secretaries of India, ICSI. However, the views expressed in this video are personal in nature and do not represent the views of ICSI, any employer, client, organization, regulatory authority, stock exchange, or government body. The channel does not provide portfolio management services, investment advisory services, research analyst services, or any other regulated financial services unless specifically disclosed and authorized under applicable laws. By viewing this video, you acknowledge and agree that all investment and trading decisions are made solely at your own discretion and risk. Copyright Corporate and Securities Law Compass. All rights reserved.